Hi, I'm Dale Matchek. I'm the chair and professor of economics here at Northwood University. Welcome to the Northwood University Freedom Seminar, an event where we try to apply the philosophy we call the Northwood idea to issues and events of the day. And we invite speakers from around the country, experts who can tell us more about the issues that are important to us. Today, we have with us Northwood's own Dr. Timothy G Nash. He's going to speak to us about the economic outlook following COVID. Dr. Nash needs no introduction to many people at Northwood University. In fact, I refer to him as Mr. Northwood. He came here as a young man. He's still young at heart. Many of you folks never had the privilege of having him in the classroom, but he is the winner of many teaching awards, the Faculty Excellence Award, and well beloved by his students and Northwood alumni. And he's done so much for the university that we all owe him a great debt of appreciation. But in addition to the work he's done for Northwood, he is the director of the McNair Center for the Study of Entrepreneurship and Free Enterprise. And they are helping us to put on this event, and we want to express our appreciation to them as well. Dr. Nash has written several books or co-authored several books with others, including When We Are Free, a textbook many of you are familiar with from your philosophy course here, and In Defense of Capitalism. He is also a consultant and has worked with the NADA Center, the Mortar and Equipment Manufacturers Association, the Michigan Chamber of Commerce, where he helped them with the research they needed to help convince our state to pass right-to-work legislation. He's also a frequent guest on radio, including Michigan Talk Radio, Paul W. Smith, Frank Beckman shows, and his writings have appeared in Detroit News, Philadelphia Inquirer, and many other major media newspapers. And he's an expert on how the COVID virus has affected our economy. He's the author of a monthly economic outlook, and during this crisis, he's been providing a daily monitor of how COVID is affecting the economy. And he's here to talk to you about that today and what his findings are. So I want to invite you to welcome Dr. Timothy G. Nash. Welcome, Dr. Nash.
Great to be with you, Dr. Matchek.
Okay, let me get my presentation up here. Can you see that? Okay, we should, oh, I can see it, so we should be good to go.
All right, very good. Here we go. Well, ladies and gentlemen, first of all, I'd like to congratulate Dr. Matchek on another great Northwood University Freedom Seminar. This seminar goes back roughly 40 years in the history of the university, and I was honored to be an assistant at the first Freedom Seminar, and I am so proud that Dale has continued the tradition and certainly done so in a big way and a very effective way during these difficult times that we're facing. As Dr. Matchek noted, we here at the McNair Center are producing a daily report that goes out literally to the Michigan Chamber of Commerce. It goes out to a number of industry associations, the 25,000 member Associate Builders and Contractors of America, the 25,000 member Truckload Carriers Association, which is most of the small and large trucking companies in the United States, and the for those of you in the automotive curriculum, the Cox Automotive Group with Auto Trader, etc. So it's really caught on, and we're also proud to say that we're part of a task force with luminaries like Steve Forbes and Arthur Laffer and former Speaker of the House Newt Gingrich, as well as the fact that the White House receives our report daily, and we've received positive impact on it. So this is the data that I'm going to be presenting today, and then I would be very happy to answer any questions that you have. The study itself really began to percolate when our president, Kent McDonald, and I started to have some conversations about, where we thought things were going with the COVID crisis, the COVID-19 crisis. And we began to look at much data, and the data was really at the early stages in late February and early March. It was really focused on China and South Korea and much of Europe, and things were really beginning to move negatively in Italy. So we started to gather data, and we said, how do we put together, or we asked the question, I should say, how do we gather data where we could put together an index and try to predict whether the U.S. economy was getting better or whether things were worsening? So we decided that we were going to put together an index. And Dale, if you move to the next slide, what you'll see is that with this next slide, the red line is our index, meaning as that index improves, it will grow taller. It'll get close to the orangish yellow line, and then up to the green line and beyond. And so right now, if you look at the index, it's a little over 57%. Once it gets up to 65%, we really believe that the national economy is in recovery, and the recovery range based on all the data is 65 to 70%. And then when it gets above 70%, the recovery is growing. And as you look at the recovery growing, what you can say is that once we get to 100%, we believe the economy, based on these indicators we put together, back to the old days. And if it gets above 100%, we actually believe that the economy has improved above where it was in mid-February. And I'll talk to you about that as we look at the next slide. So, Dr. Matchek, if you'd pull up the next slide, what you can see is that with the next slide, these are the 7 variables, ladies and gentlemen, that we're tracking. And so on a daily basis, we track the number of COVID-19 deaths in the United States. And there are a number of sources. We've, from the beginning, used the Johns Hopkins University's Medical School database. They have a wonderful database, and that one and the Worldometer, if you're looking for sources for your research studies, your reports for whatever class you're taking the Freedom Seminar for, I highly recommend those 2 indices. I don't think you can go with either one. And if you need any help with those or navigating through those, certainly send me an email and I'll help you out if I can. And so you'll see that right now we are, as of yesterday, this is last night's report. We do the report at 4 p.m. or based on 4 p.m. data. So we grab the data every day at 4 p.m. on the following 7 categories. 4 of the 7 categories we can only gather Monday through Friday. Those are the stock indices and the 10-year Treasury bond yield. But we just use the Friday figures on Saturday and Sunday, and we can get the first 3 every day of the week. Johns Hopkins reports changes every day of the week on COVID deaths, COVID cases, and thus you can then derive the mortality rate. So if you look at what we have up there, yesterday, Friday, we closed at a little above 86,000 deaths, and we now know we've backtracked. Originally, we said the first death took place on the 29th of February. We now know that that's not true. We know that it was actually early February. There's a little debate as to which day it was in early February, and now there are also a few others that are saying no, it was early or it was mid-January. We do know the death total is correct. We don't know exactly how to pinpoint the first death in the United States from the COVID virus. So if you look at where we are today, we're a little above 86,000 deaths. We're roughly 145 1.45 million cases, and we have a mortality rate that's just a little bit above 6% as of yesterday evening. And so the thing that's important to understand, and you'll be able to see this as we go through the other charts, that the mortality rate has come down, it's gone up, and now it's pretty much flattened. And if you look at where we are today, the United States is just a smidgen over 6%, and the world overall average is coming down. The world is at about 6.75 today. And so the interesting part of it is we've slowly gone up, but are flattening out, hopefully getting ready to go down again. The world has gone up dramatically. You see in countries like Italy, right now the mortality rate is over 14%, but the world average has dipped below 7%. So in many countries, things are getting better. Again, the one thing I would say to you is that there's a lot of suspicion as to what the actual number is in China, but these are the numbers that are reported here in the United States, and you can see that if you're looking at different points of interest, originally we thought that deaths in the United States could top 1 million or to maybe even 2 million if we didn't begin to human distance and even in some cases quarantine people. We then saw a dramatic decline in the estimates where a number of the key players, especially those at the University of Washington, actually thought we might have be able to peak at between 60 and 70,000 deaths total. But that didn't happen. Things picked up dramatically. And so you see that we're now looking at, we hope somewhere between 100 and 120,000 will be the total number of deaths from the COVID-19 virus. The thing that's important to understand is that if you look at the data, you will find that if you realize that there are 3,143 counties in the United States. 12 counties make up 33% of all deaths in the United States. And the largest single county would be that comprises New York City. And that's over 20,000 deaths just in New York City alone. So if you look at things nationally, and this will help us a little bit with policy and potentially economic recovery. But if we have a little over 3,000 counties in the United States, the other thing to take into consideration is that over half of the counties, about 54% of the counties, have not had one death due to the COVID-19 virus. And so some individuals are suggesting that a one-size-fits-all policy to mitigate the COVID problem and to get the economy moving in the right direction is the correct policy. One size does not fit all. Now, we can talk a little bit about that and the debates that are being had. Or if you look here in the state of Michigan, Michigan has 83 counties, and in Michigan, the 3 counties that make up my hometown or Metro Detroit, Wayne, Oakland, and Macomb County, have been anywhere from 82 to 88% of the total deaths from the COVID disease in Michigan in the last month. It's right about 84% today. So the real question is, if you put in Genesee County, you would be at roughly 90% from 4 of our 83 counties. And so again, you see the protests in Lansing to open up the economy because people are arguing, should one size fit all? And so that's kind of the data that I think is most important. We think is most important in tracking the COVID disease and trying to predict when the U.S. economy will recover. So if you move into our next 4 variables, if the first 3 variables are trying to give us a picture of how things are going relative to the COVID virus, the next 4 variables are proxies for the economy and then the movement or confidence in the economy. So we decided that the best way to try to predict the general trend of the economy would be to pick the 3 stock indices that collectively gave us the best overall picture of the U.S. economy. So we looked at the indices and analyzed the indices relative to similar indices in the affected countries. And then we chose the Dow Jones Industrial Average, because the Dow Jones Industrial Average, even though people criticize that it no longer predicts the U.S. economy the way it used to, because it certainly is not an industrial average anymore. It's been in effect, for those of you that don't know much about it, since 1890, when Dr. Dow, a statistician, brought it to the market. He'd been playing with it throughout the mid-1880s, and it was a way to predict the general movement of the economy through the large stocks. And at that time, almost every one of our large companies was an industrial company, and thus the name Dow Jones Industrial Average. Some people are saying it should be the Dow Average because you have companies like Apple in there or Amazon in there that are not industrial companies at all. So what the Dow Jones Industrial Average depicts today, ladies and gentlemen, are the 30 largest, most prestigious companies across all different sectors of the U.S. economy. The second index that we have in there is the Nasdaq Stock Exchange. And the Nasdaq depicts the high-tech side of the U.S. economy, which is the growth side of the U.S. economy. It's certainly been the growth side of what's been going on this year, even through the COVID-19 crisis. And the high-tech side is the bread and butter and the future of the U.S. economy in many ways. And then last but not least, the Wilshire 5000 index is an index that shows all of the depth and breadth of the U.S. economy. So it's probably the best, widest measurement of companies. And so some companies are in all 3 indices, most are not. But those 3 give us a real good view of the U.S. economy. You know, the Wilshire has economy or companies that have sales less than $1 billion to companies that today have reached the peak of over $1 trillion in stock value. So we're looking at the U.S. economy from the relatively small players to the major global leaders that are part of the U.S. economy. So again, we think that gives a pretty good trend as to how the overall economy is doing. And then last but not least, looking at the U.S. Treasury 10-year bond yield, we believe that points out where people think the economy is headed, not where it's at with the 3 exchanges, but where it's heading and the level of risk that people are willing to take in the economy. And I'll point this out again when we look at the slides, but I think what's important here is that if you look at the 10-year yield, what you find out is that, generally speaking, from your econ or finance classes, if you were looking at how to explain the 10-year Treasury yield, I think the easiest way to explain it would be that if people are feeling really good about the economy, they feel really good about it, and they're willing to take more risk, what they're going to do is they're going to abandon Treasury bonds because the yield is too low. And they're going to go into stocks because maybe a Treasury bill pays 2 or 3%, but they can make 7, 8, 9, 10, in many cases, double-digit growth. If you're lucky, triple-digit growth on certain stocks. So you're feeling more confident about either the individual stock or the economy. you're looking for a higher rate of return, and you put your money into stocks. And the only way the government can then get money to finance debt is to pay a higher yield. So when the government is forced to pay a higher yield, it's either high inflationary times or it's strong growth in the economy. And like the rest of us, that capital, that money that's being used to finance economic growth, from companies to the government to all of us trying to buy a home or a car, we have to pay a higher yield, a higher return, and that gets more people to put their money into the economy, whether it be in savings accounts, in bond yields, in stocks, etc. So we have to give investors an incentive to invest, and a good economy pays an investor more money. And so again, when the yield goes up, it generally means the economy is doing well and investors have a lot of good options for their money. When the yield starts to go down, what it means is that stocks are not performing well, and in the marketplace, consumers are saying, boy, I don't want to take the risk that that stock could go bankrupt, or that the price of the stock could drop dramatically, or that stock, that company could cut its dividend. And so people then determine that they are going to buy bonds instead of holding the stocks. They're going to buy government bonds, and they're going to buy them for one big reason. The big reason is that the bond, even though it's paying a lower rate of return, it's guaranteed by the federal government. And so when you look at the that type of situation, what you see is that the individual will be willing to take a lower rate of return because the bond is guaranteed by the federal government. And so when you look at it, you see that that lower rate of return is okay because the government's going to guarantee your bond. If you go back and look at or think about what happened not too long ago, what you find out is that the yield got so low that people began to think about the fact that the yield was getting so low that people thought, this is difficult. The government could be in trouble. And that was the case in the financial crisis of 08-09. And it began to be the case just about a couple of weeks ago, maybe 3 weeks ago. And you'll see when I show you the chart. But the yield got down to 0.4. And people were saying, geez, this is not worth it. And they began to sell their federal bonds and simply take cash. And then you'll also see that within that period of time, some individuals began to say, hey, it's not worth it to hold cash. And they actually traded the cash in for gold. And gold went above $1,800 an ounce. And so that's that whole scenario. When things get really risky, people abandon stocks and they go to government bonds. And when people are really concerned about the economy, they then become concerned about the government, because the government is literally taken care of by the private sector. Government doesn't exist unless there's a productive private sector to pay for, to fund, and back up with tax revenue government activity. So if the private sector becomes weakened and people are worried that the government's going to be able to survive, you'll see people will go from stocks to government bonds to dollars to precious metals. And right now, what you're going to see is that we're not having the kind of response in an upward movement, in my opinion, with the U.S. Treasury bill or the Treasury bond yield, because there are things people are worried about, and we'll talk about those things. So let me just review where we're at then. What you see with our index is you see 7 variables. The first 3 are a proxy or our way of trying to tell our readers where we are relative to COVID. Our deaths going up, our cases going up. Is the mortality rate going up? And you'll see a bigger slide in a few minutes. And then in terms of the general state of the economy, it's our 3 stock indices. When they're going down, it means things are not good in the economy. When they're going up, it means things are good in the economy. And then the risk factor or the general trend is with our 10-year Treasury bond yield. And when that's going down, things are not good. When that's going up, things are in general improving as it relates to the proverbial or the colloquial things, the general economy. So with that in mind, Dale, if we could look at the next slide. The next slide gives us a view of cases, and you can see this is total cases. And no matter what, total cases are always going to go up. Total cases will always go up. And if you look at the next slide, this is total deaths. Total deaths will always go up. And so when you're looking at total deaths, you'll see that we've gone from, just a death here. And when we started tracking it, the date was February the 29th. And that gave us 1 death to today. We're closing in on 90,000 deaths. And then here, this is one of the interesting slides, this next slide, because this shows you the general mortality rate. And you can see if you follow this closely on the news, individuals are saying that things are beginning to flatten out. And even though the trend is still slightly upward, if you remember from your calculus days, things are starting to begin to increase at a decreasing rate. And if you follow our index on a daily basis, and by the way, if you'd like to get our index on a daily basis, you can email me at tgnash, tgnash, at northwood.edu, and I'll put you on our daily distribution list. So you can see that with the mortality rate, things are beginning to flatten out. Now, if you go and look at the history, the next slide shows the Dow Jones Industrial Average over the duration of the time that we've been tracking it. If you go back to mid-February of this year, the Dow Jones Industrial Average hit its all-time record high of just above 29,500. It dropped to a multi-year low of 18,300 in early March, mid-March, and today it's back up to, it's again beginning to flirt with 24,000. So the index itself is doing a lot better from the point of view that the Dow Jones Industrial Average is improving, and it's improving for a multiplicity of reasons. And that has a lot to do with what the federal government is doing. Whether you agree with it or not, it certainly is helping to stabilize the economy. And I will say this, generally speaking, I am not in favor of the federal government getting involved in bailing out economies. But in this case, in the case that the economic failure was not due to poor government policy, it wasn't due to some failure by a group of companies. It was due to a black swan event, something that most of us didn't see, and is outside of the normalcy of an economy. I do think there's a reason for the government getting involved. To what degree, again, can be debated. And certainly government intervention is helping to keep the economy from getting a lot worse than it certainly has at this point. If you look at the next slide shows the Nasdaq. Again, remember the Nasdaq, these are high-tech companies. And as you look at the Nasdaq, interestingly enough, the Nasdaq is within about 100 points of calibrating at its record high. And so the Nasdaq has recovered much more quickly than either the Dow Jones Industrial Average or the Wilshire 5,000. And that is because the high-tech companies, ladies and gentlemen, have truly been the great performers through these difficult times. It's been the high-tech companies, high technology that has fueled new ways of getting products from A to B to C to D in terms of trucking and transit. It's been high tech that's been the cornerstone with Amazon and its ability to deliver things literally, in many cases, overnight. It's been high tech that's provided a lot of the breakthroughs or these mega computer models that have helped test treatments and vaccines in ways that we never thought possible before. It's high tech that's coming up with certain ways to produce ultraviolet machines that may allow a place like Disney World to open months early and have people walk through a 30-second line to enter the park. And once they get through the line, if they had the COVID virus on them, it will be killed by the ultraviolet rays, and some say as soon as 17 seconds into the ultraviolet line. So there are things that are happening that are literally driven by the U.S. high-tech community and other high-tech communities around the world that are allowing the high-tech stocks to flourish while the market in general is still probably about at least 15% below where it was at its market high in February of 2020. This next slide is the slide for the Wilshire 5,000 index. And like the Dow Jones Industrial Average, it's 15, 16 points below where it was at the from the trough to the peak. It dropped about 36%, and it now has about 16, 17% to get back to its all-time high. So when you think about some of those variables, it's important to look at the fact that the stock market is recovering. And some people will say, well, Nash, how can the stock market be recovering with unemployment being so high? And again, I would say to you, we're veiling or we're hiding, masking the real impact of the economy right now with government programs. One mistake I think we made was when we decided to take normal state unemployment rates and then add to that another $600 a week. So right now, one of the problems until the end of June, early July, a lot of Americans are going to do everything they can not to go back to work because, for example, in Michigan, they're getting about an annualized salary of $52,000 every time they get their paycheck. So a lot of people are making more per week or per month on unemployment than they made in their old job because the government decided to add another $600 a week to the normal state unemployment. Was it good that the government added something to the state unemployment compensation? I think the answer is probably yes. Was $600 too much? I would say it is too much in the sense that a lot of businesses are already reporting that they're having a hard time getting their employees to come back to work because they're saying, call me back in a month, call me back in 2 months. I want to collect this unemployment because maybe they were getting paid annually $30,000 or $35,000 and the employer's calling them back to that exact job at that pay. And they're saying, can't you call me back a month or 2 months later so I can continue to make this higher wage? So those are some of the things to take a look at. And for what it's worth, those of you that live in New York State, the high-end New York State unemployment rate is about $72,000 when you add the additional $600 into the high-end unemployment compensation in New York State. So it is interesting to see the kind of impact that it's having on the economy. Okay. All right, now the next slide, if you take a look at it, this slide shows our index relative to the two bars. If you look at the index, and am I missing a slide? think so. Oh, I'm sorry. If you look at the index that's up there right now, this is the 10-year Treasury bond yield. And thank you for holding back on that, Dale. The 10-year Treasury bond yield, this slide shows the fact that when you're analyzing the economy, you can see there a couple of weeks in, if you look at the yield was down to 0.4 or less than 0.5%. And people were just saying that if you're just going to pay me 0.4%, less than 0.5% interest to put my money in government bonds, that just doesn't seem worth the risk. And this was the time early in the crisis that people were saying, I'm going to switch from government bonds to cash. And then a lot of people said, I'm not even going to hold cash. I would rather hold gold, because in a time of crisis, historically, gold has been the great safety net for investments. For literally millenniums, gold and silver were money. Most people kept their wealth in gold and silver because that was considered to be the best form of money. And so people literally have, in essence, had to flee to hard currency, or in essence bartering, because the only thing in a time of true crisis that is better than gold might be food. But if you have your food and you have your shelter, most people would hold their wealth in gold or silver during times of great crisis. And so the problem that you see with this chart is, as the economy has begun to recover, we haven't been able to get the yield up above 1% or back to about 2%, which is really where it was prior to the crisis. And that's troubling, because what we're really seeing is that with all the money the government's been putting into the economy, people are worried that the government has printed too much money, even though it doesn't print it. It just clicks a computer program and creates more money. But a lot of people are worried that we are ready to experience a major inflation, and after that, a recession or a depression. And people are also worried not only about the monetary policy, but they're worried about the fact that by the end of next year, there's every chance that the total U.S. national debt will get above $30 trillion. And so people are worried about the value of the dollar, and it's those two factors are the main reason why the yield on the U.S. dollar has not increased more as the stock market has risen. That traditional relationship's been adversely impacted a little bit by the government policy to date. Okay, if you look at the next slide, and you look at the slide relative to our index, between those two lines, between the orangish yellow line and the green line, that's our recovery period. We believe that once we're in that range, the recovery has begun, and we've been close a couple of times, and we've always backed off because of conditions in the economy, such as more bankruptcies, more unemployment. There's good news and bad news. The good news on the unemployment front is that a lot of the people that are unemployed, as I just noted, are making more money unemployed than they were employed. And so the hope is, if we can get the economy rolling by the end of June, then people will actually have their jobs back, and the unemployment rate will be able to go down, and we'll still be okay. The other problem, though, that's spooked the market in the last couple of weeks, a number of businesses have gone out of business and are not coming back. Just recently, J. Crew and J.C. Penney reported that they are filing for official bankruptcy and do not intend to come back out of Chapter 11 bankruptcy. Last week, the Federal Reserve and the Department of Labor reported that we now probably have 100,000 businesses across the United States that have said they are closing their doors not to reopen when the crisis abates. And so that's troubling for the economy over the long term. And this is, ladies and gentlemen, one of the great reasons for the debate is how quickly do we reopen? And if we take our time in reopening, and I'm not saying that there aren't good reasons, well-intended reasons not to reopen right away, the real question is, what will we be reopening to? Because a number of economists predict that by the end of the month, if things don't change, we're going to have that number at least double to 200,000 businesses, and some pretty good sized businesses that will not reopen when the economy begins to spark again, begins to grow again. So that's an interesting, that's a telling variable there. And then as you take a look at it, it's important to, when you think about where we are and how these numbers come into play, the thing that I think is important is to see where we are relative to the mortality rates, and that gives you some interesting variables to think about as well. And here again, if you look at this next slide, is a slide that shows you where we are relative to cases, and looking at it as it relates to the daily change in cases, meaning what's the percent change. Dale, if you'd go to the next slide. If you look at the next slide as it relates to the change in daily cases here, and you can see total cases are sloping upward, but you're beginning to see the number of cases per day beginning to decline. And that's a percentage change. If you look here at the next slide after that, you see the percentage of deaths that are beginning to decline. And even though this has been fairly flat, it's actually starting to flatten out and get a little bit better. And then if you look at the next slide, the mortality rate, this is actually beginning to flatten, but it's been flat, and then it's increased, and now it's getting, in our opinion, ready to flatten, to go down, and hopefully this slide will be starting to go down. Dr. Fauci, who's on the president's COVID-19 task force, he and Dr. Burke are considered to be among the best in their jobs with combating viruses in the world. Dr. Fauci believes that we will have solved the problem when this number gets to 0.11. Well, right now, I can tell you for today, it's probably going to come in at 6.02 for today. I think it'll be down a little bit, but it's a far cry from 0.11 or even 0.66. And so Dr. Fauci has been quoted in a number of different scenarios. So let's just take his highest one of 0.66. We're about 8 times higher than that right now. So are things getting better? Yes, they are. Do they need to get much better? The answer is absolutely yes. If you think about it, here's an analysis of mortality rates compared to deaths, and you see that there is a flattening of the mortality rates as deaths go up. And then here, as you take a look at it, here's our broad-based index and what's happening in that regard. That's the last formal bar slide. And then as it relates to the economy as a whole, I think what's important for you to take a look at or think about with our last slide, or looking at the economy as a whole, the thing that's important to focus in on, and there's, Dale, I think I was probably talking a little too fast. That slide is, you can go past that, and I'll refer to if you can just go to the last slide, and I'll come back and look at those. There should be one more slide in there with some writing on it. There you go. Thank you. And so as you look at where we are, ladies and gentlemen, the economy grew was growing quite well, at least according to the Atlanta Federal Reserve Bank, and for 10 of the first 12 to 13 weeks of the first quarter of 2020. And then the data or the bad news from the COVID crisis came into play, and our GDP ended up being negative by roughly 4% in the first quarter, which is terrible news. And it could have been a lot worse. As we look at the second quarter, I've seen predictions out there. The low end is negative 8%. The high end is negative 30%. There's an outlier that is calling for right now negative 40%. But I really believe that the economy is going to be negative in the second quarter, and it could be as bad as, in my opinion, about 20%. So that means that unemployment is going to continue to worsen. Right now, it's closing in on 20%, and the all-time record low that we have in recorded history was the trough or the bottom of the Great Depression, when unemployment hit 25%. Could we hit 25% unemployment? The answer is yes. But I do believe that the difference between the Great Depression and today is, if our politicians handle things correctly, the Great Depression lasted 10 years or more, depending on how you measure it. And most people will say the Great Depression really ended when World War II started. So it might have gone on for another 4 or 5 years with the policies our government had in place. I do believe that we're going to see economic recovery in the third quarter and into the fourth quarter of 2020 this year. I do think that we'll see positive economic growth potentially in the third quarter, but certainly in the fourth quarter. And I believe that we're going to have a robust 2021, but that really will depend on, I think, the fall elections. I'm not a huge fan of President Trump's. I did vote for him, but I worry that with the wrong policies, 2021 could be a very slow to no recovery year if the wrong person and the wrong people get into the federal government and are influencing public policy, tax policy, regulatory policy, etc. I think higher regulations and higher taxes in 2020, which there's a good chance that could be part of the Biden administration, would cause a prolonged recession, maybe even cause a depression. And so I think what's important is to move things forward. We need to unleash the free enterprise system, reduce regulations, and cut taxes to spur the greatest recovery. We're going to have to deal, in all likelihood, with higher taxes, but it's how we levy them and where we levy them that will count the most. As you look at some of the variables, retail sales were down at their worst level in recorded modern history for April. Automobile sales were down again in April, not quite matching numbers for March, but automobile sales were down another 17.2% lower than where they were in March of this year. So a lot of the big playing stocks and a lot of the major indicators have shown that this is a difficult economy. I firmly believe that one thing that we need to do as a country moving forward is we need to have what 49 out of our 50 states have, and that is a balanced budget amendment. I think one of the most difficult things today has been the fact that we've been hit by this pandemic. We've been hit by this black swan event, while simultaneously having a national debt that's 106% of our total U.S. GDP. Our total national debt is 106% of our GDP. And that's made it extremely difficult to get through these challenging times. And so the fact of the matter is, if it's taught us anything, we need to figure out a long-term policy that's going to allow us to get out of this problem, grow the economy enough that we can reduce the deficit as a percent of GDP through higher revenue and higher growth. If you studied World War II at all, at the end of World War II, the U.S. National debt was 119% of U.S. GDP. When Ronald Reagan became president, it was a little under 34% of U.S. GDP. So from 46 to 81, our economy grew and our tax revenue grew to the point that we were capable of dramatically reducing that national debt as a percent of GDP. We need to do the same kinds of things. We need to unleash our economy so that we can grow it, so that we can create the kinds of jobs and the economic growth and stability, so that the predominant people on this call at this seminar, our students, will have highly productive careers to go forward and to start families and businesses and to have a much more prosperous America. So with that, Dr. Matchek, those are my general remarks. And if there's any clarity that's needed or any questions that the audience has, I'd love to take them.
Mr. Nash, and we do have some questions here for you. And I would like to tell our viewers that if you have a question for Dr. Nash, if you could please post it in that little Q&A icon. It's either at the bottom or the right-hand side of your screen. And continue to post those as we're discussing the first few questions here. So the first question is from Don. Dr. Nash, how do you feel about the market's recovery relative to the underlying fundamentals of the economy? And he has in parentheses here, such as unemployment numbers, government stimulus, etc.
Well, I tried to be somewhat clear on that. Let me take another shot at it. And so I think it's a great question. And the reason why I think the market is doing better than expected, or that you would think with the unemployment it's at, is due to the government intervention. The fact that there are a lot of people that are unemployed that are actually making more money than they would have if they were still employed. So the economy in that sense is not truly feeling the burden of the economy because of a lot of the government programs. Companies are getting loans to keep employees employed or agreeing to bring back at least 75% of their employees. And if they do so, that loan from the government is forgiven. And that's money that the company gets to keep. So the government is subsidizing the problem. And so in essence, things are not as bad as they appear because they're not as bad right now with government intervention. The real question that comes into play is what happens end of June, early July, when that 4-month unemployment program from the federal government that adds $600 a week to state unemployment levels, what happens when that goes away? Then the economy, if it's not rebounding, if people are not going back to their jobs, then that's when this whole thing could collapse. We could look at 18,300 on the Dow Jones Industrial Average, and we could be calling those the good old days, because if the economy doesn't get going and we collapse at that point, you could see the Dow Jones Industrial Average, in my opinion, go to as low as 10,000 or even lower. It could get that bad. I hope that answers the question.
Not the answer we were looking for, Jim.
Just call me Mr. Happy today.
That is a sobering thought, and let's hope it doesn't come to that. So Parker has a question for you. Are you able to make any educated predictions on how many total businesses you believe will not be coming back after this crisis, depending on how you believe this crisis will ultimately play out? Well,
to my good friend Parker, I would say that If I had the answer for that, I'd be sipping pina coladas on my own private island somewhere in the Caribbean called Nash Island. I don't, but I do believe that the number's going to get to at least, unfortunately, we'll lose at least 300,000 businesses nationally. And we've lost 100,000. And, you know, we do a lot of calls with this index on a regular basis. I've been privileged through the Northwood network to be able to have conversations with some of this country's great entrepreneurs and intrapreneurs, and they all have friends that have businesses that they just are worried that they're going to be able to continue. I mean, you know, for example, if you're in the business of renting office space, or if you're in the business of renting apartments or homes, you know, last month about a third of all rental payments across those two categories were not made. And, you know, eventually, if that happens for more than a month or two, those individual businesses are going to have pressure put on them by the banks. And think of the domino effect that could happen just there.
Okay. Don asks a question. I'm sorry. He's clarifying his previous question. Logan asked the question. One of our earlier speakers talked about keeping free market principles, especially during a crisis. Many others, I believe, including yourself, understand government intervention and action because this is a black swan event. Where do we draw the line in times like this?
Well, number one, I think it's a great question. Number two, I also believe the following. These dollars are our dollars. Government exists because of the free market. In other words, there would be no government. We wouldn't have the size and scope, the power, and I believe in general, the good government that we have in this country without the free market that generates the income and the consistent income for individuals and for government. And so in essence, the policy is good in these black swan events for the government and for the individual companies, because, you know, the Northwood idea is not anti-government. The Northwood idea just simply says, let's have a logical size of government, and let's have government that governs effectively and efficiently. And so sometimes here we would argue that government gets too big and intervenes in areas where it shouldn't. And as an example, I think in the early bailout, I think it's unconscionable that we would be providing $25 million to the Lincoln Center as part of a bailout in the early days of the COVID crisis. Now, I'm a huge fan of the arts, and my wife and I love to go to musicals and operas and museums, and we are supporters of PBS and the local Delta television station, etc. I think that the marketplace can and should do those things. My point is, I don't think in a time of crisis, $25 million should have been going to the Kennedy Center. I really have problems with Speaker Pelosi, and I know she's at heart, I'm sure, a good person trying to do the right thing. But why should we be all of a sudden forgiving decades of debt in states like New York, California, and Illinois for bad policies? Yeah, they got themselves into trouble. And just like I said before, it's sad that we're now facing a black swan with 106% of our debt's 106% of our GDP. That's our problem. And we should make certain we never let that happen again. Same thing with California's debt, New York State's debt, Illinois' debt. We did a chamber study for the Illinois Chamber. And the Illinois Chamber realizes that their state debt for city of Chicago and state pensions for government workers, it's in terrible shape. Well, that wasn't something created by this black swan event. That was mismanagement for decades. And the government ought to get its handle on doing things more effectively. As an example, I speak a lot for ALEC. You had one of our great alums and the executive VP at ALEC, Jonathan Williams, on the program earlier. And Jonathan and I were on a program with Steve Moore. Steve was at the Wall Street Journal at the time. And the topic of state debt came up. Alec, as you know, Dale, represents state legislators across the country. It's about 25% Democrat, about 75% Republican, very bipartisan, deals with tax issues. And one of the best ways to get rid of or to mitigate the problem of state debt with pensions is to do something like we do here at Northwood with our TIA CREF pension fund. The university puts in X amount of money each pay, and we match it, and then those dollars are managed by each employee individually. Why not do something like that at the state level? And then the government can't play around with, and unions can't play around with the pension dollars. We can't underfund it and say, oh, we'll fund it better next year, because they never end up doing it. The government should get out of the business in those states of running pension funds and create a TIA environment.
Yeah, I think you make a great point with that example, and I'm sure there are many, many more, some of which we're not familiar with yet, but which might come out after the fact. And isn't it true that when there's a lot of money that has to be spent very quickly, a lot of it is going to go towards projects that in hindsight might not have been efficient and so forth. But here's the question. Under those circumstances, and knowing that that's true, would it have been prudent to slow this down a little bit, to have more deliberation, or is it simply an inevitable consequence whenever you try and act quickly that some mistakes are going to be made, or some opportunistic politicians are going to take advantage?
Well, I think that again, if hindsight were 20/20, we'd have that group of islands in the Caribbean, and a bunch of us would all be pina coladas. And again, this is not what I'm about to say to you is not trying to be unkind to, for example, President Obama. The flip side of the equation, President Obama, I think, was a good and decent human being. I think he was well intended with his shovel-ready jobs concept. But, we went years and years after the financial crisis, and there was money that was earmarked for shovel-ready jobs that hadn't been funded 2-3 years after we were out of the Great Recession. So on the one hand, you can argue maybe we did go too fast, and that money was sent out faster than I ever thought it would be in a variety of different programs. But the flip side of the coin is I think we waited way too long to get the money into the economy during the Great Recession.
So Jeff is asking a question here. I think he's interested in the long-term consequences of government policy. How do you see the cash that the government is giving out now to stimulate the economy impact us personally and economically in the future?
That is a great question that Jeff asks. The real problem there is that as we move down the road, the key problem, the great difficulty is financing that national debt. I really believe that our national debt is going to be above $30 trillion by the end of 2021. When all these programs already administered and passed into law and yet to be passed into law, I think we're going to be at about 30 trillion. And remember, if our GDP stays the same or shrinks a little bit, we're going to be at somewhere between 135 and 150% of our GDP. Our debt's going to be 135 to 150% of GDP. And what that means long term is that we are going to have a larger interest payment on the national debt. And the real difficulty is that interest rates are going to go up. We're funding that interest on the national debt right now at right around, in the last 5 years, it's been just above or just below 2% over the last 10 years. Just think, if the debt didn't change, but interest rates went to 3% or 4%, the interest payment on the national debt in gross terms would go from about $450 billion to over $1 trillion, just interest payment. That has nothing to do with paying off the principal or reducing the debt. So we have to do things to grow the economy in order to be able to pay down that debt. And we can do it one of two ways or a combination. We can reduce the debt, or we can grow the economy so that the economy gets large enough that a stable debt is a smaller percent of a growing GDP. I'd like to see us be able to do both. But the real difficulty is that if we then turn to the belief that rich people are bad and that rich people make too much money, and we're going to tax the heck out of rich people and corporations, and in essence take away the incentive for individuals to become, at least one of the incentives to become an entrepreneur, and the money that's in best hands in the private sector, in my opinion, we're going to take that money away from creating Apple computers and creating Amazons and creating new drug companies and put it into the hands of the government. I think we will never get this debt under control, and the U.S. economy will be seeing its swan song as the world's economic leader. I really believe that. If this is going to be a watershed period for the United States moving forward, and if we don't do the things to retire debt and make things more competitive, our economy is going to suffer moving forward.
Okay.
So
We did lose your audio, but you're back now. One of the things that's difficult for any forecaster is to anticipate, and I don't think anybody anticipated 3 months ago where we would be today. And so a lot of people are wondering whether or not there'll be another spike in COVID, whether or not there's going to be rolling shutdowns. I know it's been discussed on colleges, whether they should plan on opening as usual in the fall or not. Thankfully, Northwood has planned on opening. But there's a lot of contingency plans being made. And I wondered how sensitive you think, I know you're an optimistic guy in general, but talk about the rolling shutdowns and what that could do to the long-term prospects of our economy.
Well, I really believe, Dale, that what we need to do is we need to adopt a policy nationally, which it looks like we're doing, meaning we go back to Chief Justice Brandeis, a key Supreme Court decision in the 1930s when he referred to our 50 states as the 50 laboratories of democracy. And he said that each state had the right and the ability to do things differently. So I applaud each of the states' ability to do that. And I think here in Michigan, I understand that our governor has a great weight on her shoulders. I think we're moving a little too slow, but I respect her for her position and what she's trying to do. But I would also say then, let's not adopt a one-size-fits-all policy within Michigan if we adopted a policy that was something other than that nationally. Meaning we didn't come up with a one-size-fits-all for the United States. Well, if my data is true, if four counties represent, 4 out of our 83 counties represent 90% of the deaths, do we need a one-size-fits-all policy to roll out the Michigan economy? Could we not have a number in the state where we allow the economy to open up more effectively and more efficiently, and then be able to look at how that impacts the economy moving forward? But I really believe that if we look at the economy and say, here is where we are in our area, what is the best policy? What I think is happening is wonderful. Americans and Michiganders and people in Midland and Saginaw and Oakland County, they are having true debates. And the business person who wants to open his or her business and the individual that's very leery about it, all their positions are being heard. And I think that we will come up with the right solutions. And you're already seeing certain governors that started to loosen their regulations on their economies begin to, slow things down again when deaths began to pick up. So I think that there's a tremendous amount of incentives to do the right things. And again, I don't have a medical background. I do not understand medicine the way I wish I did. Kudos and a big shout out to our doctors and nurses and hospital personnel and ambulance drivers, etc., along with truckers and all the great people that have helped us get through this difficult time. I am not blessed with that knowledge, but what I would say is that we need to look at what we're doing right now and adopt a policy that says we need to be flexible if things do turn negative, if there's a second wave, if we find out that this disease mutates in ways that we're not quite familiar with right now. We've got to be ready to fight that, but simultaneously, we also have to realize that if there's nothing for us to come back to, there is going to be a level that we're going to have to accept that a risk that we're willing to take, and I'm not sure we're at that level yet.
Well, let's hope we don't have to worry about that. I'm sure that
I agree with
we don't want to have to go through this again, and I'm not sure that the government, if it tried to support people through the next downturn, would have the resources it has now. And so
right.
Yeah. Well, Tim, we've come to the end of our session here. I want to thank you for being with us. I want to thank our participants. Again, this is the final day of the Northwood Freedom Seminar. I know that if you missed any of the previous presentations, that we will have those up at the Northwood's new YouTube channel. And I invite you to turn in to the final presentation, which happens today at 3 o'clock. And thank you once again, Tim, for all you do for our university and for being with us here today.
Dale, it was my honor. I'm so proud of you. Keep up the great work, and congratulations on a wonderful 2020 Northwood Freedom Seminar, and thank you for letting me be part of it.